why should people be getting into the market other than it's all-time lows, you can buy good deals, and if you have long-term capital, then you're good, right? Can we hedge against inflation? Is there other, like, are we worried about inflation right now in the next few years, right? If these rates keep coming down, I'm just curious, like, market sentiment on your end, Andrew. Like,
yeah, inflation's not going away.
Yeah,
it's still going to be a thing.
In inflationary times, the thing you want is good
hard assets, right? This is why people flock to gold. They flock to tangible assets. The one thing.
Now, is that why gold's skyrocketing right now?
Yeah.
Okay.
Yeah, it's a lot of fear.
Yeah.
But the other thing too that people negate is, like, if you have a bunch of debt that you take today and inflation runs rampant, you're paying back with weaker dollars later on. So you're incentivized to have good quality debt.
Like an asset investor's dream is that you buy in an inflationary time, like right now, and then that building is worth $10 million in 10 years.
Yeah.
And now you're just laughing. Now you've made yourself wealthy off of just one building and presumably
happens
have more.
all the time.
Welcome back to REI Hot Seat. Andrew Hines here with Jacob Campagnaro and David Hulshof. And we're talking about a building, obviously.
Here we are again.
Back at it.
Yeah. So
what do we got, Dave?
What do we got here, Dave?
Okay.
I see something on the screen here.
Yes. We picked this one because it's quite interesting, because when things were hot, this would have been the craziest, would have flew off the shelves deal.
Yeah, purpose-built walk-up, it looks like.
Yeah, 17 Cloverdale in Hamilton. Beautiful building. It's all 2 beds.
On the mountain?
That's a great question. Let's zoom out. It's not on the mountain. It is. There we go. Can you see that?
Yeah, that's very much not on the mountain, right?
No, sir.
No, it does look like it's on the mountain.
Zoom in more. Is this near... Isn't that where your Nona used to live, Jake?
Is this Nona's house?
Yeah, it's very
near
close.
Nona's
It's
house.
very close to Nona's
Is that
house.
on the mountain?
No, it's just below.
It's
but
just below the mountain.
It's the nicest neighborhood below the mountain.
Yeah,
in my
yeah,
opinion.
It's a good neighborhood, yeah.
Yeah, love it. Well, say hi to Nona. She's still with us?
Unfortunately not.
I'm sorry to hear that. God bless her. Okay, all 2 beds. This is a typical non-lifted units in Hamilton, like 700, 800, 900.
Yeah.
So an abysmal rent roll. Good quality tenants, a lot of elderly people in there. The people who've owned it have owned it forever. So those, love that style, right? Where it's been cared for and, the owner knows everybody and all that, but hasn't been lifting the rents on an annual basis. So this is where they get hurt.
Yeah. And this is a very typical scenario.
Is this the old Italian landlord?
The old Italian
Jake always talks about?
Yeah.
This is the one, guys. This is
we
it.
love these, except the numbers are tough, right?
And they always are, right?
Yeah.
Like even the one I toured one a little while back in Oakville. Oakville.
Yeah.
Beautiful building right downtown.
Yeah.
Awesome Italian guy owned it. He was out there cleaning the garage before I showed up.
They're
but
always
the numbers
doing that,
are like $700, even in Oakville, right? You're like, what the heck, man?
Wild.
So, but this is anyways, sorry, keep going. I got a lot to say
but
today.
just as a side, every time you go to the old Italian man's building, he's always doing something up front while you drive up, right? It's always the garbage.
Well, dude, they usually take care of it, right? It's the old work. They go to work, and then they come home, and they take care of the building, right?
Old school immigrant work mentality. I love it. So in terms of ownership, those are great to buy after you get them, because everything's been cared for, right?
Yeah.
So I was just gonna say, to add to that, if you're you want hands-off ownership, that's the type of building, because I guarantee you everyone in that building's been in there for a while.
Oh, yeah.
Right? And they got pride of ownership, they got pride of renting, whatever it's called.
Yes.
They're going to clean the hallways themselves, right? This is an ecosystem you just don't mess with.
Yes.
Right? When you start getting challenges is when you start bringing in the top market, high-paying tenants, and then they become very needy. You got to be more hands-on, right?
Yes.
So this one, I think you were saying off camera, is kind of a low price per door. It's just the rents are so low that
like 130 a unit in that area, and you saw the quality of the building from the exterior. All 2 beds. That's wildly cheap. That is so below the cost to construct. It's crazy.
Yeah.
However, what do you do with it? Right, so our model that we're selling most of our deals right now, which all the viewers have seen us do it nauseum now, is pick it up, send it to CMHC, and away you go.
Yeah.
If we look at that quickly, to hit that 1.2 debt cover, we have to be at 53% loan to value. So not great, and pretty terrible actually.
And what's the actual asking price for this building?
They want around like 1.7. I put 1.75.
Right.
I think the deal gets it done at 1.45, 1.15.
Right. And so, the easy answer, Dave, is you buy it cash. Right?
Yeah.
Or you put 50% on it, you put 50% down, right?
Yeah.
Like that's
the easiest way for sure.
That's the easiest way. That's the simplest way, but that's not why people watch this show, right? Because they go, well, Jake, if I had $1 million cash, I wouldn't be watching this show.
And even then, like you're still, zooming out, even if you have the capital, you're still buying it at like a 3.5 cap, which is not commensurate with the market.
Correct.
So huge amount of lift. Because I always say this, look, you're buying a deal, it exists on somewhere on a spectrum of completely value add to completely turnkey. Yeah. This happens to be on the very value add side of things, even though it's a really nice building.
Yeah. And there's no modern day play that you guys think for getting turnover on tenants?
I mean, the cash for keys still works if you do it with grace and talk to tenants like they're human beings. But I would suspect, having not been through this building, to tie into your comment, this is its own ecosystem. And when you think you're going to go and turn and displace tenants that have been there for 20 years, I assure you aren't.
Yeah,
and
that's going to be
it's not going to work.
No.
And even because the reality is the only hand you have to play in that is to increase the amount of cash for keys you're going to give them. But if these people are like 75 years old and
they don't care about the cash.
7 of their neighbors are their friends, they don't want it.
Where are they going to go?
Right. Yeah.
It's not even about the rent. It's just where are they going to go, right? And this is an interesting case study because we get this question a lot. At least I get it a lot. I'm sure you do, Andrew. I'm sure you've heard this question a million times, but it's like, where is the balance of cap rate versus dollar per door? Because it swings in both directions. Somebody called me the other day. Were we talking about it? Somebody was talking about it with me. They were like, the problem I'm having is we're selling. Oh, it was another agent. We were just workshopping a deal, and he's like, I have this listing. It's coming up, and he wanted to just work it out with me. So he called me and we talked about it. And he said, it's brand new construction,
right?
Gorgeous units. The rents are great, good solid rents. The expenses are low. He's like, here's the problem. At a 5 cap, it's still like 500 something a door.
Right.
And he's like, where do we balance this thing? Because and that's why you want to just pick my brain, because he's like, and he's like, it can't be a 6 cap. It's a brand new building, right? He's like, so where's the dollar per door go? And
the alternative is
this is the exact opposite. But I'm just saying that's the spectrum of that. Like, what do you?
And if the price per door gets too high, you're starting. If that's new stock, it competes with condo pricing. So if condo pricing is $550, $600, and you're at $525, you're like, well, this doesn't make sense because I'm buying 50 of them at a time.
Yeah.
So then So you just adjust the cap rate until
the subjectivity
it makes sense, and all of a sudden now this brand new building is selling for a 7 cap. Like, that also doesn't make sense.
It doesn't make sense either.
So,
and this is the challenge of, even this is why this is a great deal to discuss, is exactly this. Like, a 3.45 cap is a problem.
Yeah.
Right. But a 130 a unit on 2 beds in Hamilton is a home run.
Yeah.
So to your point, where's the line?
And I think that's really where buyer profile comes into big focus, right? And why it's so important when people call us, we dive right into buyer profile before we even talk about buildings. Like, I think you said it once. You're like, I won't talk about buildings on the first call.
No.
It's your rule. You're like, I don't even want to get. We're not even going there.
Yeah.
Right. We're talking about buyer profile because this is what we need to know, right? Like, this building, for some people out there, again, if you had the cash, even though the cap's a bit tight, so be it. You'll do your rental increases. You'll find efficiencies.
Yep.
You have a great building that you can just kind of set and leave.
Yep.
And
the other thing with a building like this is not dissimilar from the 15 unit I did. You have an elderly demographic in the building.
There's going to be natural turnover.
The one we did, the 15 unit, there was like 4 or 5 that had already submitted for homes. They just haven't got accepted yet, right? So it's just a matter of like making their life cool and comfortable while they sort of transition to whatever the next series is.
Right.
Because we always get that. Well, they'll never leave. Right. It's like, well, they will. It's just probably closer in some of these than
is there any info there about like recent CapEx or anything like that, Dave? Like, do we know roof, windows?
All the CapEx is done, with the exception of the roof is likely going to need to be done in the next 3 to 5 years.
Okay.
Everything else is very well maintained.
Okay. So build that into the deal, but so be it. Yeah.
Yeah. So you and I chatted a little bit or we all did, about strategy here. So, I'm putting a 4.25 cap rate, interest rate, which is on the decline right now, but I think that's a fair number with some cushion in it. probably
Yeah,
get
it's a
lower.
smaller loan amount as well, right? Like you're not going to get as competitive bids on that.
Yeah, especially
spread,
at
right?
50% LTV. It's a good point.
This is not one of your listings?
No,
No, this is
this is off-market deal with.
This is an
another
off-market
agent
deal.
of ours. Yeah, yeah.
Yeah, so you're thinking there's not going to be a ton of action at it. Well, people are going to be responding to the fact they can't really get the financing to.
I think there will be a lot of action. The question is, where is it going to come in, and how are people looking at it? So the first one is the obvious conversation of, is there some type of financing solution that the owners can do with us, vendor take back? Because if you've owned it forever, you probably don't have much.
That's the old Italian guy special, man.
100. They love it.
Right?
They love it. And why do they love it?
Well, what else are they going to do with the money?
Minimize taxes. They don't really want to deploy it into the market, so they get a return on their money. They get to minimize taxes because they spread it out over the.
It's secured against an asset they're familiar with, and they know how it operates, right? So they know they're not getting,
They love it.
Yeah.
And for good reason. I would if I were them too. So somebody we work with comments is always, it was actually Austin's, is VTBs can never solve the problem of buying a bad deal, right? You'll see that like people look at deals and they're like, well, I'll throw a VTB on it. But because this is a really solid
it's a good deal,
it's just the financing criteria is where the challenges come in, and that would actually be solved with a quality VTB.
Yeah.
And then if it's long enough, and if we are correct in our assumption that a lot of these people are going to homes, you can cash flow neutral or positive while you hold it.
And that's the trick with this one. Like a mistake would be to do a 1-year VTB.
Oh, for sure.
Right? Because now you're comfortable paying that premium because it will cash flow as long as you have that VTB, but then you're going to get cooked, right?
Yeah.
And so,
how long would you try and get a VTB?
I would want to see like a 5-year VTB.
Yeah,
on
3 to
this.
5 for sure.
Why does it seem like 5 years is where people cap out?
Yeah,
It's like
nobody
across
gets
the
a
board.
10-year VTB.
Yeah, well, I want a 10-year.
Yeah, you're right.
On this, I want a 10-year. Because in 10 years, that most
the
of those.
challenge, so the rebuttal I get, because we have done a number of VTBs like this with the old Italian guys, the old Croatian guys. You pick ethnicity, throw it in there, right? But like, the challenge, a lot of them are like, they are older. They're 70. They're 75. So, like, very honestly, I remember one deal we did a few years back. I was sitting at the table with the owner and my clients, and we were all just kind of working it out. And he's like, we wanted a 5-year or something like that. He's like, I actually don't know if I'm going to be alive in 5 years. He's like, I am getting very old. I have health issues, right? He's like, let's do a 3. Right. He's like, because 3, I know I'm good for 3, right? He goes, 5's a long time when you're 80,
when you're 80,
90, right?
Yeah, but if they're going to have a estate and assets, what are they going to do with the cash when they die? Why don't they just pass on a cash flowing asset in the mortgage note?
Yeah, but from a
to their
complexity
family?
standpoint, I get it. Like, especially if you're old, you're like, look, I don't want this lingering over. With them having to make those choices, I'd rather it be done and dealt with. And then if they don't want the building, they can, whatever.
Yeah. Oh, we've run into the same thing in the U.S. trying to negotiate them. Like,
it's just
we're trying to negotiate longer stuff. They're like, whoa, 15 years is a long time.
Yeah. Okay, well, here we are. So the other option you brought up, which I think is a smart one, is looking at some affordability. Right. So you tack on the affordability play. You send it to CMHC. You don't have to hit the 1.2 debt cover. You're back at 1.1.
And we didn't have time to model it.
No.
But I am really interested in modeling it because I would love to unlock a new acquisition style for somebody who wants to try to come in with less down. Right. Like, it's not going to solve your 50% LTV issue that much, because you're going to go from a 1.2 debt service to a 1.1 debt service.
Doing it right now, you nailed it. You get you to 60.
So it gets you to 60. Okay. All right. So we're doing all right.
Yeah.
All right. So it gets you to 60. You drop that price a little bit. What are we running the price at?
We are at
full pop, or are you doing the 1.4?
No, I think I'm 1.45.
Okay.
So maybe let's bring that down to 1.4, let's say. See if that makes any difference.
And this is just now noodling around, but
this is what we do best. Right? Noodling. Yeah. I bet you that'll take you to 63, be my guess.
Yeah. Like, you get this to 65, right? And then we can still get those rents from 700 up to what, 1,200? We got to find out what the market rent is.
Oh, market looking median. Like 1850.
Market's 18, but what about affordability?
Right? Oh, sorry. Yeah, I apologize. Yeah, we were thinking what?
1250, something like that. It'd be
you have to stay for the life of the loan.
Yes,
for the life of the loan, you'd have to stay there. Now, if you're only getting 50 points MLI on affordability, I think you can do a 10-year loan, like a 10-year affordability timeline. Okay. But you can still bring those rents from where they are up to the
threshold.
baseline. So you could still do your rental increases, right? So this would be an
You're
exercise
never going
to
to get there over the several, with 1-2% a year. You're not getting anywhere near 1,200.
But that's what I mean.
5 years.
So I think this is an interesting exercise. It can be running the numbers. We could look at it and go, no, that makes no sense at all.
Yeah.
But I'm just hypothetically, if you go through that building and you're like, man, nobody's leaving. Like, we're not doing cash for keys. There's nobody's going to homes, right? This is what it is.
Set it and forget
it's
it.
an option we could look at, right? Because then you're in there for 10 years anyways.
Because I mean, look, the lift on this thing is like 100%. Like there's so much equity to it.
All you need, like, if just one turns over, if you don't do the affordability, one turns over, because really, is it worth it for the 5 points you get on the loan to value?
Right.
If
not.
one person
Great
turns
point.
over, you're boosting your income by like $1,000.
Yeah.
Which is why I love that you go back to the VTB. You get a good quality VTB on it. You get a bunch of turns, right, naturally.
Yeah.
And then you send it off to CMHC when it's done.
I still think you need that cap rate.
What cap
more in
rate
line,
is it
though.
actually worth? Like, on the market, normally this building would be what, a 5.5?
Yeah, 5 to 5.5.
So $12,000 in a year is added by turning over one tenant, divided by a 0.055 adds. Is that right? $218,000 of value.
What did you do? You did the delta between the rent now and the rent?
Yeah, just 12,000. So 1,000 boost if you went to market from some of these rents.
Yeah, because we've got the spread to
so
market.
1,000 a
here.
month, 12,000 a year divided by 0.055.
Yeah.
You get $218,000 value boost.
Yeah.
Which makes sense, because if you turned all of them, or when it turns eventually 11 units at 200 and change, you're doubling your purchase.
Yeah.
100% lift. 100, 110.
I mean, we know there's plenty of room on the price per unit, so that valuation isn't going to be a problem.
What would you say a building like this taps out at on value per unit? 250?
Like at a 5.5 cap, it's 291 a door, so that might be a little, like, maybe we call it somewhere between a 5.75 and a 6 cap, because 6 cap's 266.
Yeah.
If they're rent out in that market in a building like this,
Good area, yeah.
yeah. Because then could you sell this for 266 a unit at a 6 cap with
I think so.
at
I'd imagine.
85% LTV?
Yeah.
CMHC? Yeah. So I'd be comfortable at that range.
Yeah.
So there's a huge range of value add here. Just no obvious play to force it.
So interesting too, like you get this deal, you get a VTB, you start just managing it. Whenever the market picks up, like this thing would go for a fortune if you go back in time, or presumably forward in time, right?
I really like it.
Yeah.
It's
I really
great.
like it.
And to your point, like the buyer profile, I bet you there is a groups or individuals out there, they want to own a quality asset.
Yeah.
They're not really that crazy about the cash on cash. Like I get that a lot, right? These people, like, I don't really care about that.
Well,
just want a quality asset.
Well, what's the goal, right? Why are you investing in real estate, right? And I think, again, like if we go back in time, this is one of the biggest challenges we had. People were investing in real estate because it was cool.
It's become less cool very quickly.
That's one way of
Not
putting
so
it.
cool anymore.
Now they
but
do
no,
true,
but that's I think important for this one. Sorry, Andrew, let's just finish my thought. Like that's important for this one, where it's like, if it's wealth preservation, right, or just I have cash, I need to put my cash somewhere. I want to hedge against inflation. I want to, whatever it may be. It's a great asset for it.
Yes.
Right? Really nice, solid area. Throw your money in there, throw your 50% on it, and just that's it. Your money's there, and it's only going to go up.
Yeah.
Right. Like it's very hard for this building to continue to come negative in value when you're already, hundreds of thousands under reconstruction value.
If you buy this, and you're not in the red when you buy it, and you're cash flowing positive, nobody's upset they bought this building. Yeah.
Andrew, sorry, you were saying something.
Oh no, I was just gonna say the drugs wore off.
Yes.
Yeah.
Because that's really what it was. I was talking to you guys about this in 2019.
Yeah.
The real estate meetups. 100 people would come out to those, and you remember those, Jake.
Yeah.
All I had to do was just talk about it on my podcast, and people just pour in because their uncle or their brother just bought a pre-construction and made $200,000 on it, and I want to get in too. And everybody's just all hyped up, and now it's just like pain is more associated with real estate than success
100%.
nowadays.
Yeah.
So now it's like only the savvy and determined are still in the game.
The people we talk to now are like real OGs.
Yeah.
Like people that have been in it for a while, right? And they're like, we've seen this twice already in our investing career.
You know what? We're doing a lot though with even still a lot of people with putting the CMHC debt on it, sending cash flowing positive. Like there's still a good, strong buyer pool.
Yeah.
And that's the thing. Sorry, I don't mean to cut you off. Did you finish?
Go ahead.
Okay.
Yeah.
And that's the thing. Like I want to reiterate to, smaller investors, newer investors, first-time investors, whatever it may be, like the fundamentals of what was happening a few years ago are still there. Like we can still take a deal, bring it to CMHC, have it cash flow, right?
Yeah.
And arguably, it's actually the best time to be doing that, right?
Sure.
So, yes, there's a big pool of people that are licking their wounds and trying to recoup losses, right? And maybe they may have to take the sideline for a little bit.
Yep.
But, if you do have capital, like, I'm sure you hear this from every realtor, but it really is a good time to be buying. It's a good time to be placing capital in the market.
I follow this big investor, and he tracks markets, and there's the fear and greed index.
It's like all-time high right now in
And
the
he
markets.
only invests when fear is really high, and greed is low.
Yeah.
And he does the opposite, sells.
You've talked about that
which is
before,
just Warren
I think.
Buffett's 101, right?
Yeah.
Fearful when others.
Yeah,
greedy,
what
greedy
would
when
you say?
others fearful.
I mean, it seems like the market's very, very optimistic right now, at least from a stock standpoint. They're like insane all-time highs.
Stock market for sure. Crypto, the fear is reasonably high, although shifting, and it seems like real estate, that fear is reasonably high as well.
Yeah.
And it's interesting to your point, like the solid fundamentalists are out buying, and there's definitely a good pool of buyers that are doing good quality
Well, and I think
deals. Now's the time.
Correct me if I'm wrong, but I think I started to see articles pop up again regarding fear of inflation, right? Interest rates are starting to come down. I think they have to continue to come down. Everything I've read is that they are coming another 100 basis points.
Right.
Well, we just had another cut.
We had 25 bips, right? But I think I read an article the other day. It was saying Bank of Canada has to continue cutting rates. We're going to see 125 basis points in the next, whatever.
And there's nothing they can do. Like, you can't turn around. Like, it's like a shotgun wound and they're putting a Band-Aid on it. Like,
Oh, for sure.
What can you really do when, like, GDP per capita was such garbage and then they stopped immigration? That was the only thing propping it up. Like, and then add the tariffs and the slowdowns and the economic slowdown to that. It's like, you're going to have to see some more rate cuts till they get to the bottom of what's known as the neutral rate, where it's not stimulating. And then it looks like recession is in store. Now, that doesn't translate directly to real estate.
Right.
But, I mean, from an economic standpoint, like, just knowing where people are at.
And I'm curious, right? Because we've talked about the psychological part of investing, the fear and greed, right? And now I'm curious, like, why should people be getting into the market other than it's all-time lows, you can buy good deals, and if you have long-term capital, then you're good, right? But, can we hedge against inflation? Is there are we worried about inflation right now in the next few years, right? If these rates keep coming down, I'm just curious, like, market sentiment on your end, Andrew, like.
Yeah, inflation's not going away.
Yeah.
It's still going to be a thing.
In inflationary times, the thing you want is good
hard assets, right? This is why people flock to gold. They flock to tangible assets. The one thing.
Now, is that why gold's skyrocketing right now?
Yeah.
Okay.
Yeah, it's a lot of fear.
Yeah.
But the other thing too that people negate is, like, I have a blog post on this. I think I sent it to you. Is like, if you have a bunch of debt that you take today and inflation runs rampant, you're paying back with weaker dollars later on. So you're incentivized to have good quality debt.
Like an asset investor's dream is that you buy in an inflationary time, like right now, and then that building is worth $10 million in 10 years.
Yeah.
And now you're just laughing. Now you've made yourself wealthy off of just one building and presumably
happens
have more.
All the time.
Yeah.
I mean, we've got a client that's their entire model, big family office, and all they do is just they're out hunting aggressively right now. But he was a ghost for like the last couple of years, and now he's ready to go. Right?
You just got to. The big thing is you just got to be willing to weather the storm, because the inflation is followed by massive rate hikes, which drive down your asset value in the short run, and then it now needs to recover. So you need to be ready for that cycle.
But and also negated by good quality CMHC debt. If you have a 10-year CMHC debt,
the 10-year is highly advantageous, especially at a time like this. Take the 10-year and then set it and forget it.
For sure, because when things skyrocket and you turn around, you can find somebody that's going to assume that debt.
Yeah.
So you literally have the trifecta of all this power. Yeah. So, that's why we get so excited. That's why a lot of times what we're showing is the same stuff, because this is what works. Right?
It's true. Like, as far as a play goes for a long term, you would assume that look back at history, like 10 years has usually been enough to cure any problem in the real estate market.
Yeah.
It's recovered its nominal value, maybe not in real terms, but give it time. And I think there are a lot of people that this kind of deal does work for. You just can't be that hungry for a high cash on cash rate.
What you can't do with deals like this or any other deal is buy it with private debt or expensive debt and hope you're going to turn tenants and hope. Those are the ones we see.
That's where we're in trouble.
That's
right?
where we.
And then going all the way back to fundamentals of investing, like real estate investing is not a super profitable play, right? Argue with me if I'm wrong, but
it used to be.
Cash flow.
That's why the drugs. That's why the drugs wore off.
Short term, you mean?
Yeah. Long term, yes, of course, right? So again, that's the goal. But 2-3 years ago, like Andrew was saying, like the drugs, the whole thing was like, I quit my job because I own 4 apartment buildings and it's cash flowing so well I don't actually need to go to work anymore.
Yeah.
Like, how many full-time investors there were that owned like 3 buildings, and you're like, oh, you're a full-time.
Right. With the whole, and
like,
the money wasn't the cash flow. It was what their exit value was going to be.
Yeah, they were pulling out massive refis.
It was the
refis.
refis.
Those dollars.
Correct. They just kept refining every 2 years, and they were retired and then all of those people are now back at work, right? Like, I talk with them still, and they're like, yeah, got my job back.
Yeah, it's because they didn't stick to fundamentals.
Right. And that was an incorrect statement, what I originally said, but it's profitable. It's very profitable, but it's not like, if you need cash, go get a job, right? If you need cash, buy a business, right? Go look at hotels, go look at glamping resorts. Like, there's other asset classes that you should be looking at if your goal is short-term cash flow right away.
It used to work like flipping, right? Like, a lot more. I mean, I say that we literally actively flip for income, but a lot more people did it, and it especially here became a very precarious opportunity, because you're no longer being saved by the market going up on your flips.
Yep.
That helped everybody, right? Like, you could be a little over on your renos, you're a little off on your numbers. Now it just forced everybody to be so bang on with their numbers that most are out of the game.
Yeah.
Yep. Doesn't mean you can't. There's still people actively flipping in Ontario and crushing with it.
Absolutely.
Ironically, doing better than they were before.
Yeah.
If you take the same team in this market, they're doing better than they were.
Oh, yeah, because now you don't have the competition of all the other letters.
Yeah.
Now they're only getting one handwritten letter, not 10.
It is interesting when you watch this sort of unfold, because it is exactly the same as always, which is just like, now's the time, start getting,
it's like, the OGs, going back to what we said, they don't go anywhere. They keep doing it.
Yeah.
And then the rest fall away, and then and then the fanboys and fangirls come back when the market gets good again.
And the OGs sell their assets to those.
Literally,
that's what happens. So interesting deal. Last little plug. I love the larger units, right? Because if you think about Toronto condos, we get that question a lot. A lot of those Toronto condos are 450 square feet, tiny little things. And you get buildings like this, all 2 beds with a huge footprint. Yeah, those are nice rentable proproperties.
Yeah, because this would have been built, what, the 50s, 60s?
Yeah.
They built stuff big back then.
They built it big and built it right.
Yeah, it was like an anomaly in the whole world. There's nowhere in the world that they ever had units that big as like the 50s and 60s in North America.
Yeah. They're huge.
Yeah, just the abundance here post-war was just like unparalleled.
Big cars, big units.
Yeah, big cars. You ever seen one of those big Cadillacs that's literally like 30 feet long?
One drove down the street the other day. I was out having lunch.
I think you've never seen anything like it.
And everybody looked at it. I was like, that wouldn't fit in my driveway.
Yeah.
And we have 2 cars in my driveway and a couple motorcycles. I was like, that car, legit. Yeah. I was like, I want one of those.
Yeah. It's like a 4-seater limo. Yeah.
Yeah, that was cool.
Yeah.
But they're massive. They're boats. Yeah. Those old cars.
Alrighty, guys. Is that a bow on this one?
Yeah, let's wrap it up.
Right.
Okay, guys, you've made it this far. Below the video is a link to the Insiders Club, the Insiders Club for REI Hot Seat, and you're going to want to join that, because that's what gets you in touch with Jake and Dave and team, and also you get access to their insider deals that you wouldn't have opportunity
deals
to
like
otherwise.
This, right?
Yeah.
This is something we'd package up, and we'd have that buyer profile laid out, and then we would say, we're going to call Bob today, because you know what? Bob's a good fit for this building, right? 100%. And so we really tailor it. It's not a shotgun approach. It's a very direct campaign.
And access to a calculator that I think you were a big part in building back in the day.
Probably had my hands on it.
Yes, I believe you did. So a lot of good stuff in there.
Sweet. Yeah, so guys, take a moment, join up with that, and then share this video with somebody you think it might help, because we'd love to see the show grow. And we'll see you again next week.
Appreciate it. Thank
Have a
you.
good one.
Thanks, guys.